Hello, everybody. Happy New Year. Luke Gromen, FFTT. Hope you are doing well. Hope you had a great holiday. Hope the year has gone well for you thus far. In the interest of brevity, I'm going to jump right in. As always, thank you for submitting the questions. Really appreciate it. Love the back and forth. Helps spur a lot of great ideas and thought processes. So, always very grateful for it. So, let's jump right in. First question is from SM. Luke, would love a clear explanation of the impact of fiscal dominance and how this plays out in simple terms. You often get very technical, and don't explain your terms. What is the way out besides Bitcoin? I'm already in that camp. All right, I'm going to be in as simple of terms as I can. I'm going to be very direct. Debt to GDP is too high for the U.S. government, 125% debt to GDP. U.S. deficit to GDP, too high, 7% of GDP. U.S. government share of spending, U.S. government outlays, U.S. government spending is 25% of GDP. So it's a quarter of the annual economy. Fiscal dominance needs to be understood from the context that increasing government deficits is stimulative. Doesn't matter where they come from, ultimately they're stimulative. That's really important. So, with the context of the figures I just laid out, the Fed raises rates to slow inflation. What's going to happen? Deficits are going to rise rapidly because debt to GDP is 125%. As a result, that's stimulative. If the Fed cuts rates to try to make the interest expense more affordable, that's going to be stimulative because cutting rates is going to free up private sector balance sheet, stimulative for all the reasons that has always been the case. And so the key is that the debt is so high that raising rates that would normally slow the economy won't really work because you're just going to blow the deficit out. So what is the way out of it? The way out of it is either you allow the rise in interest rates to drive interest expense up, but then the fiscal side has to cut in order to not have the deficit increase, in order to not stimulate the economy by raising rates. In other words, entitlements got to get slashed, defense has to get slashed. Those are the only two things big enough to cut to offset the rise in interest expense. So the ways out are either you have negative real interest rates. In other words, your interest rates on your debt are below the rate of inflation, and you can either do very negative for a little bit, or you can do a little negative for a long time, or you can restructure the U.S. Treasury debt. We're not going to pay it, we're going to cut it, we're going to term it out at zero for a long time, something kind of crazy like that, which isn't going to happen. Or you have a productivity miracle, or you're willing to take the pain, which is, hey, we raised rates and we're going to cut defense, we're going to cut entitlements drastically, 25, 30% immediately, permanently. Not going to happen politically, and it couldn't really happen economically because, again, your debt is so high, that's going to touch off a debt spiral. So that's fiscal dominance. Fiscal dominance is the debt and the fiscal side is so big, it's overwhelming the monetary side. From Nate, can you explain what the incoming administration may do to help weaken the dollar and bring down interest rates? Lots of different levers. I think they're likely to be cobbled together. Timing is key. If you get the Fed to cut rates when they shouldn't be, i.e. when inflation is bottoming and rising, that could get the dollar down. You could monkey with the inflation metrics to make inflation look lower than it actually is, in order to convince the Fed to cut rates when maybe they shouldn't be. This may sound conspiratorial, but there's historical precedence for this. FDR did this. Nixon did this, I'm told. And you can also mess with how you calculate that inflation, like I said. So Larry Summers came out 2 years ago, not even, 18 months ago, said that if you calculated inflation as it was calculated in 1983, inflation would have peaked in 2023 at 18%. Not 8. So again, you can do these types of things, but they have to be incremental going forward. You could bid gold prices or let gold prices rise more aggressively. All else equal, that will start to help weaken the dollar. You could do various regulatory changes that free up balance sheet capacity, exempt treasuries from the SLR calculations for banks. It's basically QE through the banks. And in extremis, you could do yield curve control or its functional equivalent. That would work too. So, as I said, timing matters. The path matters. But there's a lot of different things they could do. I ultimately think you'll probably get some sort of cobbled together grouping. From John, I believe you've referenced foreigners owing roughly $13 trillion of U.S. liabilities versus holding roughly $50 trillion of U.S. assets. $8 trillion of which are treasuries. And that's about right. So it's a $13 trillion of dollar-denominated debt, $22 trillion net of dollar assets, $57 trillion gross, $8.5 trillion of treasuries. So the conclusion I've made is if dollar appreciates, they'll sell treasuries to defend their currency, and that spikes treasury rates. So the question is why would they sell anything? Their assets are way higher than their liabilities. If the ratio is even close to above, even small yield mismatches between assets and liabilities, for example, low dividend receipts in versus high interest payments out, wouldn't create a shortage of dollars for them. It's a good question. So without getting too into the nitty gritty, dollar up means global growth slows. That means that U.S. deficits go up. So as global growth slows, U.S. deficits go up. So the amount of treasury issuance goes up. While private balance sheet, global private sector balance sheet to finance the rising deficit shrinks because global growth is slowing. And so you have a rise in deficits, a shrinking in capacity to finance those deficits. So that's going to increase U.S. share, the U.S. demand, the U.S. call on global savings that year to finance existing U.S. deficits. That's going to drive the dollar up. And because U.S. interest expense, government interest expense as a percent of global GDP growth is getting too high. So then the dollar squeezes more. As that happens, rates go up more as U.S. share, interest expense share of global GDP growth goes up. Wash, rinse, repeat, and it creates that squeeze. Also, because oil for most countries is still mostly priced in dollars, oil basically equals dollars. So as oil goes up, the same dynamic happens. And if oil and dollars are going up, it happens even faster. So the $64,000 question at any given point in time is how strong is too strong in terms of oil prices and dollar prices. And those numbers go down as U.S. deficits to finance go up and as global GDP slows down. So hopefully that helps frame the squeeze that happens and why it forces that selling. From NC Smoky Mountains, you frequently warn that we're in turbulent times and don't use leverage. Are you referring specifically to buying securities on margin, or are there other types of leverage you would recommend we avoid? Yes, securities on margin, absolutely. But not just that. I would avoid unproductive or excess unproductive debt, consumptive debt in particular, of any stripe, as well as margins, as well as taking out a margin of comfort on any productive debt. What do I mean by that? Don't overhouse on debt. You want to overhouse paying cash? Overhouse away. Don't borrow a lot and overhouse. Cars. Don't overcar on debt. You want to pay cash for a Lamborghini? Knock yourself out. It's not what I would do, but you only live once. Don't buy a Lambo on credit. Not productive. Don't put anything on your credit card that you can't pay off at the end of the month. Ideally. I understand that's not everyone's in that situation. But to the extent you can, to the extent you can cut out things you don't need, if you don't need it and you're putting on credit and you're not paying off credit card at the end of the month, that's the type of unproductive consumptive debt I'm talking about. The other thing is to make sure to stress test your incoming cash flow assumptions on any productive debt, right? So you borrow money to buy a piece of light commercial real estate. What are your cash flow assumptions? Have you stress tested them for a severe recession that lasts 3 months, 6 months, 12 months, 24 months? I would take a look at all those things. I think in the end, when you think about debt, the way I'm thinking about debt certainly is the key metric is on productive debt in particular, my margin of comfort needs to be, can I last longer than the US government? Can I last until the US government needs to start printing? So the US government can always print the money to pay their debt. The question is, how fast will it happen? That's why I'm so focused on this true interest expense as a percent of receipts. Last 4 months, it's been 103%. So last 4 months, true interest expense, 103% of receipts. U.S. government can't last very long if they have a recession. I don't think it's going to happen, a recession. But if one happens, like, they're going to have to start printing QE, whatever, weaken the dollar fast. And then that's going to create the dynamics we've seen. And it's going to bail out productive debt, such as we might have. So with that said, it doesn't mean we can't have a painful 3 months, 6 months period of time, which is why you want to stress test that productive debt, and you want to avoid that unproductive consumptive debt. So that's what I mean by avoiding debt. From BTO, if you had $100,000 of spare capital to invest this week, where would you deploy it? How much would you keep in cash? Knowing what I know today, and this could obviously change, and this is for me, so this is not a recommendation. This is for illustrative purposes. Everyone should make their own decision on what works for them, consulting with your financial advisor with those caveats. For me, knowing what I know as things stand today, 20,000 in Bitcoin, 20,000 in gold, 15,000 in electrical infrastructure equities, and $45,000 in T-bills. And if I was going to move some of the $45,000 out of T-bills, it would be if I saw weakness in Bitcoin, weakness in gold, I would start shifting it out of there on downdrafts in Bitcoin and gold. Because ultimately this year, I think we are going to see a weaker dollar and more liquidity injected. And that'll be great for Bitcoin and gold if I'm right. But between here and there, the next 2 to 3 months, very political. I have no visibility, and that's why the cash is so heavy. So that's what I would do. Again, everyone's different. From Jacob, is 98.2% allocation to Bitcoin irresponsible for someone in their 30s? In my opinion, extremes in anything are imprudent. Yes, they can't take your Bitcoin, sort of all the things that we know about Bitcoin, but gold was illegal to own in this country for 41 years, from 1933 to 1974. They never took your gold, not technically. You could have hidden it, never given it to them, but it would have been really hard to move for 41 years. If the in and on ramps are on and off ramps in the United States, in the dollar system, for whatever reason, again, I don't think this is going to happen, but this is why 98.2% I think is imprudent. Can you wait 41 years? Again, not saying that's going to happen. I'm overweight Bitcoin. I like Bitcoin. To me, I don't want my Bitcoin allocation being so big where if something extreme like that happens, suddenly I have to make a choice. Do I want to be a criminal? Do I want to leave this country and renounce my passport? I don't want to do those things. So that's a position sizing issue to consider. There is historical precedent for that type of extreme. I don't think it's going to happen, but it's something we need to be aware of. I would say though, we are off the reservation in terms of like the Overton window of sort of normal outcomes has been blown apart. And that's why we do have to think about, I think, extremes of positioning in anything. Look, if you said, hey, 98.2% in US Treasury bonds, I would tell you the same thing. 98.2% in gold, I would tell you the same thing. 98.2% in stocks, real estate, I would tell you the same thing. It's imprudent in every case because we're off the reservation in terms of the extremes in leverage, geopolitics, long debt cycle, a bursting global sovereign debt bubble, all these things. We're in uncharted territory historically, and that needs to be reflected in positioning, in my opinion, to be prudent. From David, how might a transition to a neutral reserve asset look? What is the time frame? What are the potential mechanics of making a transition work? We're 10, almost 11 years into that transition. 2014, global central banks stopped buying treasuries on net. They started buying a lot more gold. And we can see how that has worked. Basically, U.S. runs deficits, sends foreigners dollars, and they're buying gold in their reserves, not treasury bonds. And so the mechanics, paradoxically, that all else equal, drives the dollar up because it creates a dollar short squeeze. As foreign central banks are price insensitive buyers of treasuries, they don't buy those treasuries. Those treasuries have to go into a more free market, and they squeeze interest rates up. They squeeze out other dollar borrowers, squeeze the dollar higher. So paradoxically, central banks stopping buying treasury bonds is mechanically good for the dollar till the dollar gets too high, creates treasury market dysfunction, and then the Fed and or Treasury inject dollar liquidity in order to make sure that the US government can afford its debt without printing money. And that is good for gold. And it's good for gold in particular relative to treasury bonds. Since global central banks stopped buying treasuries on net in 2014, gold over TLT, the long bond ETF, is a beautiful chart. It is beautiful. It just is, it goes up and to the right, very small drawdowns. It is like the macro unicorn. The unicorn in macro is something that has very steady returns, very small drawdowns year after year after year. And long gold, short long-term treasuries is that. And barely anybody in the US has it on in the macro world, because it's, as I was told, there's career risk to it. I was told a year and a half ago, Luke, if I own treasuries, they go down 30%, I keep my job. I own gold, it goes down 30%, I lose my job. In America, it's how it works. By the end of the cycle, I suspect it'll be the other way around. But there's a lot that tells me there's a lot of green grass on the long gold short treasury secularly between here and there. But that is how it is happening. It has begun. It's 10 years old. It's likely going to keep happening because of geopolitics, because of peak cheap energy, peak cheap oil in particular, and the continued de-dollarization of global commodity markets. So with that, I'm going to finish up for the night. Thank you as always for joining me. If you like these updates, check out FFTT-LLC.com for more information about our tree rings product, 10 most interesting things. Brief synopsis about what grabbed our attention about them and whether it's changing the way we were thinking about the world or confirming it. So have a great rest of your week. Thanks for joining me. Take care.